Okay, so part two of today's lecture. Let's talk a little bit about kind of the big topics and big themes that we're going to talk about in this class, and then also some of the, I would say, kind of the definitional or background information that we need to have as we move forward to talk about these themes in more detail. So this class has three big topics. In fact, in some ways, this class is really kind of three different classes kind of squeezed together. We're going to talk about how financial markets operate. That's going to be really the first order of business here this first week of class. Financial markets, meaning we're going to talk about how bond markets work, talk about how stock markets work, and then at the end of class, we're going to talk about how foreign exchange markets work. All right, so the first big thing we're talking about in this class is financial markets. The second is financial institutions, primarily commercial banks. So next week, second week of class, the primary focus will be on how commercial banks operate, including we'll talk about, well, I won't even get into it. We're going to talk about a whole range of issues related to commercial banking. And then the third topic in this class, which is really going to be the focus of the third week of this class, is monetary policy in the Federal Reserve, okay? And so let's talk a little bit about all three of these things as just a means of introduction. First off, let's begin by talking about monetary policy in the Federal Reserve. You might say, well, why are we talking about the Fed in a course about financial markets and commercial banking? The simple answer is you can't understand financial markets. You can't understand commercial banking unless you understand how the Federal Reserve operates, right? That's never been more clear than just the last couple of weeks with all the financial volatility associated with coronavirus. It's been hard to understand what's happening in financial markets if you don't understand how the Fed's actions have played an important role in, quite honestly, maybe preventing things from being worse. They're not great, but they could have been worse. And so we need to talk about what the Fed is, right? You should all be vaguely familiar with the Fed from taking principles of macro, right? The Fed is the United States central bank and plays an important role in managing monetary policy, meaning interest rates in the money supply. And it also plays an important role in regulating the financial system, particularly regulating banks. Monetary policy impacts inflation, it impacts interest rates, it impacts output. And as a result, it impacts the value of almost every financial asset in financial markets, and it impacts every aspect of banking, right? And so that's obviously one of the important things that we're going to have to talk about. Just to show you some visuals here. Oops, sorry to scroll on you. One of the things we're going to be wanting to talk about here is the aggregate price level in the United States, right? And you can see how this is so closely related to the money supply, meaning that the Fed has by directly controlling the money supply, the Fed has a very close impact on the aggregate price level. Here we can see in figure 6, and by the way, this is a figure from your book. Here we have money growth rate related to interest rates. And once again, we see this correlation between the growth rate of the money supply and interest rates within the US. And then finally, we look at money growth and the business cycle, meaning output growth, right? And as I said, money growth plays an important role. What we are tending to see here is that money growth tends to go up during business cycles, or it tends to go up during recessions, and it tends to go down during expansions, which if you think about that, that might be a little confusing, right? Shouldn't money supply go up during good times and go down during bad times? It's not exactly what we observe. And so, we need to talk about how the Federal Reserve operates, how it works. And we will do that, as I said, in the third week of this class. First week, though, we're going to be talking about financial markets, right? And so that's one of the other three big topics we're going to be talking about. So financial markets, primarily bond markets and stock markets. So let's talk a little bit about financial markets in general, and in particular, just kind of introduce some introductory definitions and some introductory concepts that you'll need in moving forward with the material, moving forward with your readings. So financial markets are often referred to here as direct finance. And why direct finance? Because basically those who are borrowing borrow directly from those who are saving, right? So as opposed to using a bank, which we will call a financial intermediary, financial markets directly match up savers with investors, borrowers with lenders. When we think about financial markets, we really have to think about two types of financial markets: primary markets and secondary markets. Okay? Primary markets and secondary markets. What's a primary market? A primary market matches new issues, right? New issues. So new bonds, new stocks that are issued for the first time are issued through what's called primary market, right? This process is called underwriting, right? So the term underwriting basically means when a financial institution helps a business sell new issues of bonds or stocks. Those financial institutions are called investment banks. Okay, so this is some very confusing terminology. An investment bank is not really a bank. An investment bank is a financial institution that helps firms sell new issues of their bonds and their stocks in a process that we call underwriting. Okay, when underwriting occurs, it often can occur through a broker or through a dealer, right? So here's some more lingo that we should get familiar with. What's a broker? A broker is somebody who matches up a buyer or seller. A dealer is somebody who stands ready to buy or sell for themselves, okay? So a broker would find a buyer and match them up with a dealer. You might think of a broker as like, for instance, a real estate agent is a broker, right? They help match up buyers and sellers. A dealer stands ready to buy or sell for themselves, right? So for a dealer, if you came to them and said, I want to sell this bond, the dealer says, okay, I'll buy it at this price. And then if you want to buy a bond, you go to the dealer and the dealer would say, okay, I'll sell it to you at this price, right? So they have a holding of the asset by which they're ready to stand, where they're ready to buy or sell, okay? So what investment banks do is they serve as kind of an intermediary in this process of new issues. That's what we call the primary market. The secondary market then is when the existing bonds and existing stocks get sold, right? And so when we think about, for instance, the New York Stock Exchange, the New York Stock Exchange is a secondary market. It's basically where buyers and sellers of stocks that are listed on the New York Stock Exchange come together to buy or sell. The NASDAQ, the American Stock Exchange, these are all different stock exchanges that are secondary markets. You might ask, which is more important, the primary or the secondary market? Quite honestly, it's probably the secondary market, because without the protection of having the ability to sell a stock or a bond once you bought it, you wouldn't buy it or sell it in the first place, right? In other words, in some sense, you need secondary markets to have primary markets, right? No one's going to buy or sell these bonds in the first place unless there's some assurance that they're going to be able to sell these things. When we think about markets, we usually think about markets taking two forms, financial markets taking two forms. The first is through an exchange. An exchange is a market that actually has a primary location. Oftentimes a physical location, but it doesn't have to have a physical location. An exchange would be the New York Stock Exchange, right? On Wall Street, there's a building. Even though very few trades actually take place there, there is a physical location where the trades take place either physically or virtually. And so, the New York Stock Exchange it has a primary location, as opposed to an over-the-counter market, which is basically a computer network of brokers and dealers. There is no single location. So, for instance, the U.S. Treasury bond market is an over-the-counter market. There is no physical location for the treasury bond market. It's just a bunch of brokers and dealers that are networked together virtually, who stand ready to buy and sell treasury bonds, right? So these are financial markets, right? Often known as direct finance. Let's talk about the major forms, or the major financial markets in the US. The first and the largest is the bond market, right? Or we can think of this as the debt market. So what makes a bond a bond? Well, bonds are a method of trading money now for money later, just like every form of finance, with conditions attached. What makes a bond is it has a specific set of conditions attached, right? Bonds represent a claim for future payments with a fixed coupon interest rate, meaning that the interest rate that you get paid for holding the bond is predetermined. It has a maturity date that is predetermined. In other words, the amount you borrow has to be paid back at a specific date. It has a face value. A face value is the amount that you borrow today. And then finally, the payment timing, when all of these payments have to be paid back, all right? So once again, a bond has four conditions attached to it. What is its interest rate? What's its maturity date? What's its face value? When are these payments made? Okay, that all bonds, right, have these four conditions attached. The specific conditions are going to be different for different types of bonds, but these are the things that all bonds have in common. We hear a lot about the stock market, but we don't hear a lot about the bond market, which is always confusing, because as I have written here, the bond market is about 1.5 times as large as the stock market, right? In the United States, bonds are the primary way that firms finance their activities. And so while stocks are kind of sexier, right? Maybe because stocks go up and down a lot, and maybe there's more of a kind of idea that you can get rich in the stock market. As we're going to talk about, bonds are plenty risky, and there's plenty of money to be made or lost in bond markets as well as stock markets. One of the things we observe about bonds, as we see here in Figure 1, is that the interest rates on all types of bonds tend to move together, right? So here is this figure, and actually, if you have your book or you have an electronic version of the book, it might be easier to see these figures if you look in your book. But this has the interest rate on U.S. government treasury bonds, which are long-term bonds, U.S. Treasury T-bills, which are short-term bonds, and corporate bonds, right? And one of the things we see here is while there are some individual movements, in general, all of these interest rates tend to move together. We can also see from this figure that interest rates tend to be volatile, right? There's a lot of day-to-day, month-to-month, year-to-year movements in interest rates. And one of the big trends we see here is that there is this peak in interest rates in the late 1970s and early 1980s, followed by this kind of long decline in interest rates that we've seen since then. And then since 2010, relatively low and stable interest rates that have, since, this doesn't have the most recent data, but since the pandemic, interest rates have fallen even lower. So we'll have to talk about why all these interest rates move together and what are some of the things that drive these trends. Having said that all these interest rates move together, though, you also notice that there are significant differences between these interest rates. T-bills tend to have lower interest rates than T-bonds. Treasury bonds tend to have lower interest rates than corporate bonds. And we will talk about why that is here as we go forward. Of course, when we talk about treasury bills and treasury bonds, why is the government issuing bonds? Well, because they run deficits and they have a debt that they have to finance. And so one of the things about understanding treasury bond markets is understanding what's happening here to the government's borrowing and in theory, lending, but from the US government perspective, primarily borrowing. Here we can see US deficits as a percent of GDP. And you'll notice here the huge spike in the deficit as a percent of GDP in 2008 during the global financial crisis. And if we had more recent data, we're going to see another spike, right? This pandemic, the government basically had a $2 trillion rescue package. $2 trillion is about 10% of GDP. So, calculating this it's going to take a while to kind of calculate how big this is, because some of this money hopefully will be paid back. Some of the money that the government has lent out to small businesses and to the airlines and to other to the rest of the travel industry, hopefully some of this will be paid back. Only time will tell, but yeah, we can almost certainly expect to see a pretty significant spike in government borrowing here, and that will definitely play a huge role in what's happening in Treasury bond markets. It already has played a huge role, and we'll talk about that here as we go forward. Stock markets. All right, so stock markets represent a claim on future earnings, right? What do you get when you buy a stock? Well, what you're getting is limited ownership, right? What you're really getting is you're getting a right to vote for the board members, right? And you are also getting, I don't have this written up here for some reason, but you are also getting a share of any distributed earnings, any dividend payments, okay? So when you buy a share of stock, you're really only getting two things: to vote for the board, and if the company decides to distribute dividends, you get your proportion, right? So if there's 1 million shares and you have one share, you get 1/1,000,000th of the dividends. But that's really the only thing that you're guaranteed to get, right? That is the only thing you're guaranteed to get. It is limited ownership, right? So if I buy a share of Apple, I can't just walk into an Apple store and put an iPhone in my pocket and say, don't worry about it, I own this place, right? That's not the kind of ownership you get. Now, one of the things about limited ownership, though, is limited ownership is a good thing, right? for most investors. And the reason is, yeah, it's true, you get a limited ownership of assets, but you also have limited liability. And that, of course, is a huge reason why corporations were started in the first place, is that the nice thing about owning a share of a corporation is if that corporation goes bankrupt or does something horrible, the corporation cannot come to you and say, we're going to take your house, right? I mean, all that you are responsible for is the money that you spent on the share of stock, right? You have no additional liability over and above that. And so that reduces your downside risk, right? It reduces your downside risk. And so in many ways, stocks are a way of reducing risk, right? It's much less risky than, for instance, starting your own business and possibly taking a second mortgage on your house to start that business, right? That is risky, and you're not protected from personal downside risk the same way that you are when you buy a share of stock. Of course, when we talk about stock markets, we usually measure them by an index. And an index is really looking at a group of stocks all together and seeing how the price of that group of stocks moves over time. And so here in figure 2, we're looking at one of the probably the most famous stock index, the Dow Jones Industrial Index. The Dow Jones Industrial Index looks at the share prices of the 30 largest stocks in the United States. So it's actually quite a bad index, right? In that there's only looking at 30 companies. It's not a particularly broad look at what's going on in the US economy. But for whatever reason, it's followed closely, and so here you can see what's happened to the Dow Jones over time. This leaves off what's happened here recently. At the time that I'm recording this lecture, the Dow Jones has dropped by about 40% from its peak. So there's a pretty sharp drop there that's not recorded in 2020. And of course, as we all know by watching the news, stock prices are quite volatile, right? And they're volatile for a couple of reasons. First, there's default risk. the fact that the company could go bankrupt and you won't get your money back. And then the other reason is because there's no guaranteed payments, right? Firms don't have to make dividend payments. Unlike with a bond where you have to make your interest payments, you don't have to make dividend payments. And so that adds an element of risk. Okay, and then the third financial market that we're going to talk about in this class is we're going to talk about the foreign exchange market, the FX market, which is where we trade currencies. And of course, what's determined in the foreign exchange market is the exchange rate, right? The price at which one currency trades for another. In figure 8, here we can see the exchange rate of the US dollar. I believe that this is against an index of currencies, right? A broad index of currencies. And once again, we see lots of volatility. Foreign exchange market is crucial to understanding finance, in part because international financial markets are so internationalized, right? And so in the US market, in the US stock market, the US bond market, there are millions of foreign investors. And to buy into US assets, you have to first be able to trade for US dollars. And so we need to understand how exchange markets work if we're going to understand how US financial systems work, because it's an important way that which the US market is linked to world markets. Okay. I'm going to take a break here. And then we're going to come back and we're going to talk about specific financial market instruments.